Hello and welcome back to Invest with King. Warren Buffett's widely known for his wisdom in investing, and one of his most famous quotes states, "The stock market is a device for transferring money from the impatient to the patient." At this moment, we're witnessing one of the most significant tests of patience. The S&P 500 has fallen 10%, the NASDAQ 100 has taken a harder hit, and the Russell 2000, representing small-cap stocks, has plummeted by a staggering 20%. Fear is gripping investors as market volatility surges. The VIX, often referred to as the fear gauge, has spiked to 30, while the fear and greed index has plunged to 14, a level classified as extreme. However, what many are missing is that these are conditions that long-term, disciplined investors have been waiting for. Market turmoil, uncertainty surrounding tariffs imposed by the Trump admin, and more have fueled extreme volatility. On top of this, uncertainty surrounding the Federal Reserve's interest rate policy is keeping traders on edge. Fear dominates the market, but as legendary investors John Templeton once remarked, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Right now, we are firmly entrenched in that pessimistic phase, the precise moment when billionaire investors like Templeton, Buffett, and others build their fortunes. The reality is, we're not witnessing a market collapse, but rather a necessary correction. Corrections serve as the market's way of resetting, shaking out weak hands, and setting up remarkable opportunities. This environment is fertile ground for investors who can identify fundamentally strong companies that have been unfairly punished. In this analysis, we'll examine 3 top stocks that have suffered significant declines but have the potential to deliver extraordinary returns for those willing to seize the opportunity. Alphabet, parent company of Google, is currently trading 21% below its peak, an unjustified discount considering its tremendous growth. While many investors focus on short-term fears, they're overlooking the fact that Alphabet is no longer just a dominant search engine giant. It's rapidly emerging as a powerhouse in AI and cloud computing. Google Cloud, Alphabet's cloud computing division, has experienced phenomenal growth, reporting a 30% increase in revenue. This demand for AI-driven infrastructure is surging, positioning Google Cloud as a key player in this space. Meanwhile, Alphabet's Gemini AI models are setting new benchmarks in AI, introducing cost efficiencies that could significantly disrupt the AI industry. Despite concerns about AI competition in search, Google's advertising revenue continues to climb. Search ad revenue has grown by 13% year over year, while YouTube ad revenue has surged by 14%. In its most recent earnings report, Alphabet posted a remarkable $96.5 billion in revenue, reflecting a 12% year-over-year increase. Even more impressive is the company's profitability. Operating margins have expanded to 32%, while Google Cloud's margins nearly doubled in just a year. This proves that Alphabet is not just scaling its AI and cloud computing businesses, but doing so with improving profitability. Despite these strong fundamentals, Alphabet's stock is currently trading at one of its cheapest valuations in decades. Historically, its price-to-earning ratio have been ranged between 23 and 25, yet it now sits well above that level. Even if the stocks merely revert to its mid-range valuation, it could rally by over 28% from current levels. And that's not without factoring in the long-term growth potential from AI and cloud computing. This is the type of opportunity that patient long-term investors like Buffett and Templeton capitalize on when short-term fear creates long-term value. Another stock that's been unfairly punished in the correction is Amazon, currently down 20% from its peak. However, much like Alphabet, this decline is more about short-term noise than long-term fundamentals. Investors remain fixated on recession fears and trade war concerns, missing the fact that Amazon is undergoing a transformation that will shape the future of automation and AI. Amazon's been steadily building one of the world's most advanced robotic ecosystems. Its journey into robotics began in 2012 with the acquisition of Kiva Systems, and today Amazon has over 750,000 robots deployed across its fulfillment network. But this shift is not just about reducing costs. It represents a massive new revenue stream that will likely follow the same trajectory as Amazon Web Services. AWS started as an internal tool to support Amazon's e-commerce operations before evolving into the dominant cloud computing business it is today, generating $90 billion in revenue. Now, Amazon is applying this same strategy to robotics. By integrating AI into its warehouses, Amazon is gaining an unparalleled expertise in automation. It is now rolling out AWS-powered robotic services for third-party businesses, setting the stage for a major disruption in industrial automation. The industrial robotics market is projected to reach $60.5 billion by 2032, and AWS is positioning itself at the forefront of this revolution. With its RoboMaker platform, Amazon is enabling companies to develop, test, and deploy AI-driven robots at scale, mirroring what AWS did for cloud computing. Meanwhile, Amazon's retail operations are benefiting significantly from these advancements. The North American retail segment, once plagued by low margins, has turned profitable, reaching an 8% operating margin thanks to AI-driven supply chain optimizations. Morgan Stanley estimates that robotics could save Amazon over $10 billion annually by 2030, further boosting its profitability. Despite these promising developments, though, Amazon is trading at one of its lowest forward P/E ratios in years. This market remains distracted by macroeconomic fears, failing to recognize that Amazon is evolving into a dominant force in AI-driven automation and robotics as a service. This is the exact kind of market inefficiency that savvy investors can capitalize on. The third stock to watch out for in this correction is Nvidia, which has seen its stock price drop 23% from its peak. Nvidia has been at the heart of the AI revolution, yet many investors underestimate the scale of the opportunity ahead. Nvidia's most recent earnings reports was stunning, with revenue soaring by $17.2 billion year over year, representing a remarkable 78% growth rate. The company has guided for $43 billion in revenue for Q1 2026, yet Wall Street continues to underappreciate the momentum behind AI infrastructure spending. Nvidia's latest Blackwell AI chips are seeing unprecedented demand, generating $11 billion in sales in Q4 alone. But this is just the beginning. As Blackwell chips reach full-scale production, this quarter, Nvidia is poised to exceed analyst expectations once again. Looking ahead, the real game changer will be Nvidia's long-term roadmap. At the upcoming GTC 2025 conference, CEO Jensen Huang is expected to unveil groundbreaking advancements in AI, digital twins, quantum computing, and next-gen AI infrastructure. Nvidia is not merely leading the AI revolution, it's laying the foundation for the future of computing. Despite these catalysts, Nvidia's stock has been caught in a broader market volatility, shedding hundreds of billions in market cap in just 2 months. But history has shown that these are precisely the moments when large-term investors make fortunes. With AI spending accelerating, Nvidia is at the forefront of innovation and new products are on the horizon. This dip represents a rare buying opportunity. Market corrections create some of the best investment opportunities, and the current environment is no different. Alphabet, Amazon, and Nvidia are 3 of the most compelling stocks that have been unfairly punished. With AI, cloud computing, and automation reshaping industries, these companies are well positioned for massive long-term growth. As Buffett and Templeton have taught us, it's during times of fear that the greatest investment opportunities arise. The question is, will you take advantage?